Hello, I'm Brian Sylvester and welcome to TNM TV News. This week, Freeport-McMoRan takes a big write-down on the Phelps Dodge takeover, B2 Gold takes out Central Sun, and Cliffs gets a stake in the Ring of Fire. But up first, Freeport-McMoRan has posted a whopping US $13.9 billion write-down in last year's fourth quarter. Most of that loss stems from the $26 billion takeover of Phelps Dodge in late 2006. But Freeport President and CEO Richard Adkerson is still defending his big-ticket purchase. Here is Northern Miner staff writer Kip Keane with more.
It was a tough quarter for Freeport-McMoRan Copper and Gold. It posted a $13.9 billion net loss. The loss mostly stemmed from impairment and goodwill charges related to its $26 billion takeover of Phelps Dodge in 2007. With the market downturn, its assets have decreased in value. But Freeport-McMoRan President and CEO Richard Adkerson defended the deal in a conference call with analysts. He argued not only has the merger helped Freeport pay down $10 billion in debt, but that the combined company had a stronger global presence, set of exploration and development projects, and mineral reserves. As for 2009, Adkerson also announced more cuts to production above and beyond those taken in December. Copper output will fall 9% instead of 5%, and molybdenum goes down 25%, not 12.5%. There was good news for gold, though. Output will hold steady at 2.2 million ounces in 2009. Likewise, Freeport sees further cuts to copper and moly production in 2010. Copper output will fall 17% and moly 40% over 2008 numbers. Adkerson also gave an update on progress at Freeport's 58% owned Tenke Fungurume copper and cobalt project in the Democratic Republic of the Congo. He tempered concerns over the DRC government's review of mining contracts there. He said while discussions are ongoing, key government officials have told Freeport that the government will honor its contract with the company. I'm Kip Keane reporting for the Northern Miner in Vancouver.
Thank you, Kip. In other news, Thompson Creek Metals, one of a handful of pure molybdenum plays, is also slashing molybdenum production. Falling moly prices have forced Thompson Creek to close all of its moly mines for 1 month this summer. When all is said and done, Thompson Creek will produce 1/3 less moly in 2009 than it did in 2008. Moving away from moly, iron ore giant Cliffs Natural Resources is buying roughly 15% of junior KWG Resources. The junior owns 1/4 of the Big Daddy chromite play near McFalls Lake in far northern Ontario. Cliffs could own almost 20% if it maxes out its buy-in options. Mac Watson's Free West Resources owns 50% of Big Daddy, while Spider Resources owns the remaining 25%. Now over to Northern Miner editor John Cumming and his view on Rio Tinto's increasingly cozy relationship with Chinalco, China's state-owned aluminum giant.
There's plenty of speculation over Rio Tinto's future and just what the debt-crippled giant might hand over to its deep-pocketed 9% shareholder Chinalco. You might regard it as another small move in a historical geopolitical power shift from west to east. Now that BHP Billiton's bid for Rio Tinto is off the table, the pressure is getting intense for Rio Tinto management to meet its pledge to chop at least $10 billion from its $37 billion debt load before the end of the year. Rio Tinto has just sold to Vale its undeveloped potash assets in Argentina and Saskatchewan, as well as the Carumba iron ore mine in Brazil for $1.6 billion. It also confirmed it was in discussions with Chinalco over the sale of minority interests in some of the group's operating businesses, as well as possible convertible instruments. Chinalco is said to be especially interested in becoming a joint venture partner with Rio Tinto at the latter's iron ore and coal assets in Australia. Also of interest to Chinalco are large copper assets, such as Rio Tinto's stake in Escondida, the world's largest copper mine in Chile. If Chinalco wants to buy more Rio Tinto shares, it's limited to a 15% interest under current restrictions imposed by the Australian government. Though if Chinalco boosted its stake to the current maximum, that would still represent a nice $2.8 billion cash infusion for Rio Tinto. A short-term way for Chinalco to further invest in Rio Tinto and still get around the 15% barrier is to take on some type of convertible instrument. These types of sales and offerings would allow Rio Tinto to quickly hit its $10 billion debt reduction target. On the buyer's side, it's all part of the Chinese government's long-term aim to secure low-cost raw materials for its growing economy, and now is an especially good time to buy, with commodity prices having at last bottomed out. Left out of the recent asset sale talk has been Rio Tinto's high-quality diamond business. It's not a core asset, and holds little strategic interest for the Chinese government, but Harry Winston Diamond has expressed an interest in upping its stake in the Diavik mine it shares with Rio Tinto. As for a Rio Tinto rights offering, it's widely seen as management's last choice as a fundraiser. This is John Cumming, editor of the Northern Miner.
And that's all for this week. Don't forget to look for Susan Kerwin's upcoming profile of Cameco trailblazer Bernard Michel. Until then, thank you for tuning in.